Good afternoon, everyone. My name is Jeetna, and you are watching Mentor. Mentor is a live weekly show presented by Dutch Uncles. Our guest mentor for today is Mr. Chinmay Ananda, who is a financial educator and business storyteller.
Hello, Chetna. How are you?
Hello, Mr. Ananda. Thank you for joining us today.
Thank you for having me.
So, I would request you kindly take over the show.
Great. Thank you. Thank you once again, Dutch Uncles and team for having me present, or rather, I would say, pay forward my learning that I have learned over the years as a startup founder, as an entrepreneur, now as an investor from my mentor. So this is something that I probably say that I'm really, really lucky and fortunate to have had the kind of mentors and coaches from whom I have learned, and I pay forward through my training programs. Now, quite a few people were really curious about today's topic, which is about how is that investors invest in companies that are not making profit. Now, initially, even I was taken aback when I got to know that the so-called billion-dollar companies, the unicorns, when people were investing and they had investors that the founders could choose, they were not making profit, but still investors were investing. And this is where one has to understand the mindset of an investor, what makes an investor invest, and why is that they still invest in a loss making company. Now, I would love to keep all my training sessions or presentations interactive. However, I understand this is getting live streamed, and no, I mean, you may not be able to unmute yourself and ask question. However, if you have got any question, then feel free to type it in the chat box so that I can immediately see on my screen, and I'll be more than happy to answer it. And let me also try to ask a few questions and hope that someone will answer. I'm not sure how that is going to work. Last time it kind of worked to an extent, but every time now it's with technology, it's something new that we keep learning. Now, if at all we have someone who is watching this as of now live, I would love to hear from you. I would like you to answer this question: why do you think investors invest? I repeat, why do you think investors invest? Now, I'll not wait for the answers. However, this is something that I keep asking my audience, and most of the time people say, Chinmay, you know what? Investors invest because, in fact, we have got someone who has typed in saying to gain more profit. They want to make more money. So more or less, most of the time, it is all about they want to make more profit, they want to make more money, they want to get good returns. However, these answers are not measurable. When we say good profit, when we say decent profit, when we say good return, the word good is not measurable. So this really made me curious to really understand uh, the kind of mindset an entrepreneur and or moreover the investor has. So for that, let me quickly share how I ended up changing that mindset as I'm kind of an investor myself these days. I hope that you can see this image on my screen. For those of you who love bikes, especially kind of no the bikes like Harley Davidson and Bullets, then I'm sure that you might go, "Wow, it's cool." Uh, this is my bike. This was back in 2008. I purchased this bike, this model. It's 1971 model, so it's like it has got that vintage value. However, when I bought it, it was in an auction, the police auction, and it was not in running condition. Now, as they call it a Gujri condition. Not even in a running condition. It had the body, it had the engine, but everything was rusted, so you couldn't even start. So I think I bought it for like 20,000 rupees. This was back in 2008, 2009. And those days I was working, I was kind of juggling between few startups. I had very limited income, out of which 35,000 rupees I was supposed to pay to the bank, the educational loan that I had taken. One thing I knew, if I did not save money or put money somewhere, I would have somehow used it. I'm sure you can all relate to it. End of the month, where's the money gone? So I said, you know what, let me start investing and start building this bike from scratch. So I made sure that I got the authentic parts from Delhi, from Hyderabad, and slowly, now every month or so, 2,000, 5,000 I used to give to the mechanic, and he was slowly building this. Now, over a period of time, I think it took 1.5, 2 years to get it completely to this condition. This was somewhere in 2010. And yes, of course, this is me trying to show off and have these images on Facebook to get some likes and wows. So I think I spent close to 1.5 lakhs over the period of 2 years. And then when I asked, people said, you know what, Chinmay, if you're ready to sell, I will be more than happy to buy it for 2 lakhs. In 2012, I went to Australia, and I have predominantly been in Australia for the last 8 to 10 years. And I came back. Until then, I had given it to my friend because I didn't want to sell it. But however, I was kind of curious to know what is the value of the bike. This was back in 2018. Now, what's the value of the bike in 2018? How much people are ready to buy this? So what the mechanic said, sir, if you're really serious, let me know. I'll get the genuine buyer. You say 2.75 or 3 lakhs, and you can settle down somewhere for 2.5 lakhs. Meanwhile, as I was doing a lot of research and was investing in quite a few places in mutual funds and share market and things like that, I was reading an article about Eicher Motors, and then they are the ones who own Royal Enfield brand. The share price of Eicher Motors back in 2010 was 950 rupees per share. If I had invested 1.5 lakhs in Eicher Motors instead of me building or rebuilding the vintage Bullet, today the share price, or back in 2018, the share price was 30,000 rupees approximately, which means if I had invested that 1.5 lakhs in Eicher Motors rather than building the bike from scratch, I would be sitting somewhere close to 47 lakhs. Now, if I had to put myself in the shoes of an investor, and if someone approached probably back in 2010 and said, Chinmay, you know what? Instead of investing and rebuilding that bike and spending 1.5 lakhs, why don't you invest in shares in Eicher Motors? It will give you 3 times your investment. I would have definitely said yes, but here it was 30 times. Now today, do you think if someone says that, Chinmay, you know what, buy another Bullet, rebuild it from scratch, and you can sell it for double the price, do you think I'm going to say yes? Definitely I'm going to say no, because I have experienced something called as opportunity cost, and I know there are many other options, other opportunities that I can rather invest in. So this is something that is very important for us to understand, especially because this is how the mindset of an investor is. So let me tell you, one of the best answers that I have got for the question, why investors invest. Investors invest if you make them believe that you can help them make more money with their money than they would have done with their own money. I repeat, investors invest if you make them believe that you can help them make more money with their money than they could have done with their own money. So let's say an investor has got 1 crore that he or she would like to invest. Now, what are some of the options that they have in front of them? The so-called safest investment is in a bank, fixed deposit. It might give 4, 5, 6% return depending on the tenure of that deposit. The same 1 crore, if it is invested in, let's say, mutual funds, the return is anywhere between, on an average, 6 to 8% or more than that these days, not in the first year, after a few years, compounding effect. The same 1 crore, if invested in private equity, 12 to 13, 14%, on an average, like 1% a month. The same 1 crore, if it is invested in, let's say, share market blue chip companies, then the return might be anywhere between 15 to 20%. The point I'm trying to make here is, an investor with that 1 crore sitting in his or her office or bedroom in front of their laptop, they have the potential to make sure that 1 crore can generate a return. They can get a profit in return that can generate anywhere between 5 to 20%. If they are thinking about investing in a startup, then I'm pretty sure that they want to make sure the return is more than 20%. In fact, many a times it is 50, 100, even 400%, which is like 4 times. And this is something that we have to understand, because many a times, in fact, most of the time, when someone is investing, they're not investing as of now looking at what's happening. They're investing what might happen for that company, what might happen in that industry. Like simple example, I think this was back in 2005, 4, 5, something like that, in Bangalore. This is where I was born and brought up. When the government decided that no, we are going to have the international airport in Devanahalli. Before, there used to be something called as Old Airport Road near Leela Palace, the 7-star hotel. They said we are going to have international hotel, and the land, everything is finalized. Immediately from next day onwards, the agricultural land, which was worth few lakhs an acre, was selling for few crores. Suddenly, investors are like, you know what, I know the potential of this land because there is going to be an international airport. Now, was purchasing that agricultural land was going to make them profit? Definitely not. But they were seeing an opportunity in the future where the valuation would multiply 3, 4, 10 times more. So that's the mindset that I would like you to carefully observe. So let us further understand this by understanding of the first thing, which is when we say profit, what profit are we referring to? Because very loosely we use this word profit. Are we referring to gross profit, operating profit, net profit? So let me quickly break down the profit and loss statement. We have revenue, top line, sales. Now, by the way, in case if you have got any question, feel free to type it in the chat box. I'll make sure that in the next 25 minutes, I will stop. In fact, less than 15, 20 minutes, I will stop my presentation and I'll be open to take more questions. However, if you send in a question, I'll be more than happy to answer it if it's relevant with regards to what I'm discussing. So any profit and loss statement, we have revenue, sales, top line. Let's say in this case, it is 1 million or 10 lakhs. Then we deduct something called as cost of goods sold. In short, they call it COGS. Now, simple example, let's say you are selling coffee, you have a cafe. Now, to sell coffee, you need ingredients like coffee powder, coffee beans, milk, sugar, so on and so forth. So any raw material ingredient that is required to make a cup of coffee will fall under cost of goods sold. Same thing, if you want to manufacture this pen, what are all the raw materials that are required to manufacture this? Cost of goods sold. If it's a service industry, we call it cost of sales. Revenue minus cost of goods sold will give us GP, gross profit. So this is one of the profit an investor would like to know. And if you take any company, even billion-dollar company, the chances are this gross profit will not be negative. This will be positive, which means they will make sure that they are selling that cup of coffee at least for more than what it is costing them. In simple words, if let's say I have taken a loan for 10%, I will make sure that I will give that money to someone. I might loan that money, the same money to someone for more than 10%. Very rarely, we will give it for less than 10% unless we have a strategy around it. So when we say profit and we are referring to gross profit, most likely this will always be in green, which means this will be positive number. Then we have all the operational expenses. We have rent, we have a salary, we will have all the utility bills. They all come under operating expenses. Now, gross profit minus operating expenses will give us something called as operating profit. Accountants love to call it as EBITDA. If you're new to this term, then hang on. In fact, you can ask Professor Google to get an understanding of what this EBITDA is all about. Earnings before interest, tax, depreciation, and amortization. Now, I don't want to get into this accounting terminologies. Now, depreciation, it's a non-cash operating expense. For example, to make a cup of coffee, we need coffee machine, we need utensils. How are we going to associate a cost for using that coffee machine, that utensils? Depreciation is the answer. So let's say EBITDA minus depreciation will give us EBIT or PBIT, profit before interest and tax. Now this is another profit. This might be in red, which means this might be a negative number in many so-called fast-growing startups. Even billion-dollar companies where people are still investing a lot of money, this might be negative because they are heavily investing to make sure they have the sufficient resources and assets. It might be expanding into new location, having more office space, having more I don't know, computers, having more people working for them. That those expenses will come under operating expense. So chances are this might be negative. And if it is negative, then obviously business has to again find money from somewhere. So whatever is the gap, let us say monthly expense is 10 lakhs. However, they're generating only 5 lakhs. So gross profit, let's say it's 5 lakhs. So 10 lakhs is the operating expense, 5 lakhs is the gross profit, the gap is 5 lakhs. So that is where they say 5 lakhs is the cash burn rate. So they're burning the cash on an average 5 lakhs per month to make sure that a day will come when they will hit that break-even point where even the operating profit number will be positive. Then yes, now if at all they have taken a loan from a bank, the chances are very less if it's in a startup stage because they would be going after the funding. Then we get PBT, profit before tax. This is another number people would like to know because on this number, they end up paying tax. And you might have heard all the governments, doesn't matter which country it is, they might say all these multinational companies, they don't pay even a single dollar as tax, because they would be showing a negative profit before tax number. So obviously they will not pay any tax. So in this case, let's say this is the tax amount. Then we end up with net profit, the bottom line, profit after tax. And let's say this is the number. Now this amount belongs to the shareholders. Of course, all of it cannot be taken. So the board of directors, they decide how much of it should be divided among the shareholders. So that is why it is called dividends, and the rest of the money gets reinvested back into the business, which means the equity of the shareholders goes up. Now, investors would like to see this to make sure at least business is making some kind of a gross profit. Of course, if at all more profits are in green, then they would be more interested. But at that stage, the valuation of the company might be really high. It's like the government has announced that Devanahalli is the place where they're going to have international airport. And if someone decides to invest after a year, obviously the cost of the land will be very high because already people are able to make sure that it is generating some kind of a return. So let me quickly run you through different stages of funding as such. There is something called as pre-seed. This is where it is still in the idea stage, where someone can write a check anywhere between 5 to 10 lakhs, where the money will be used to convert an idea into MVP, minimal viable product, where the idea is kind of exciting. The team or the founders are really passionate. They know what they're doing. Probably they have got some experience. So this is where probably the first time investor or someone in their circle might invest. So what they want to know is, with that 5 or 30 lakhs that they are going to invest, can they get the product ready to the market, at least to test and see how the market is going to react. So the beta testing, the prototype for that hard launch. And then again, they want to make sure that by getting the feedback, can they immediately change the product or the service that they're offering? So are they agile? Then they want to make sure that they build some consistency. And if at all they see a customer coming back once again, asking for the same product or service, oh boy, investors would be really excited, simply because someone has seen value and they want it again, repetitive. And this really gets an investor excited. If any startup ticks most of these boxes at a very early stage, then people would be interested to invest further. And most of the people who invest in this are family, friends. The three famous are family, friends, and fools. And these days, even angel investors would like to jump onto this opportunity at the very beginning so that they can buy or kind of negotiate a good share in the business, so that once the company is taken to the next round of funding, the valuation of the company will be higher. So imagine someone has invested 30 lakhs and they're valuing the company at 3 crores for the next round. Easily they have made 10 times the money. Probably they wouldn't have even sold the product or service. Even even the gross profit at this stage might be negative. But still, investors would like to invest because they are in the valuation game first and then the profit game. So this is why they want to make sure that the companies that they are investing can go to the next stage, next round of funding, where the valuation increases by 2, 3, 4, 10, 15. No, there's no limit for it. And again, all startups, investors look at a startup as a high risk game. People like Warren Buffett never used to invest in a startup until 2018, where he invested. In an investor's world, for them, success is if their investment has generated at least 2.5 to 3 times a return in 1.5, 2 years. So 18 months, if they are able to get 2.5 times the money that they invested on an average, then for them that's success. Now, investors, they know that all investment may not generate a good return. In fact, one of the famous venture capitalists said, we are as good as our next investment. So this is how they play the game. They go, you know what, if at all I have got 10 crores to invest, I would probably choose 10 startups and invest 1 crore in each one of them. And they know for sure 5 to 6 of them might miserably fail, which means they may not even get back the money that they've invested. 1 or 2 might give them 1.5, 2 times the return. And there might be another one on an average 1.5 that might give 2 to 3 times. But there might be that one startup that might end up going to become a unicorn, which might give them 10, 15, 20, or even 100 times the return. Like, for example, when Google decided to acquire YouTube, now YouTube was not even generating much sales through ads. I think back in 2000, was it 6, 2009, something like that, Google acquired YouTube for 1.5, 1.6 billion. Today, after 10, 12 years, almost every week, YouTube is generating a revenue that is more than 1 billion. They were investing in the future. And at that time, YouTube was not making, forget gross profit, not even much sales as such. So once the pre-seed funding is done, then they go to the seed funding, where the money that they might be raising might be anywhere between 30 to 1 crore. So people want to see that there is attraction already. There is some kind of a product that they are selling. This is where investors want to invest to slightly increase the size of the team, probably have it as a proper office, and they know that there is some kind of a recurring avenue. So they make sure that they can accelerate the traction that they have built over a period of time. To an extent, they've understood what not to do, who their target market is, and then who are those people who are ready to give that money in exchange for the service or the product. And they would like to hire the key team members, because they are the ones who would be again expected to replicate in other different locations. So many a times, even first-time investors would be interested, and again, angel investors would be interested in investing. The valuation, they would like to see it somewhere between 5 to 10 crores. Now, there is no rule of thumb saying that only in seed stage 30 lakhs has to be raised. It might be even less, it might be even more. Now, for example, Kunal Shah, with the cred idea that he came up with, no, the first round of funding itself, I think it was like 80 crores. It was still just an idea. But again, it was Kunal Shah who had proven himself, who got the highest kind of exit, close to like $500 million back in 2016. So the trust factor was built, and people were investing actually in him because they knew that he is that guy, he is that real deal. it was still an idea. Forget about profit. Not even sales was done. Not even they had a product as such. Then they go to the Series A funding. You might have heard of this. Anywhere between 1 to 10 crores. Usually, as it's all invested in US dollars, they might say 1 million. They might, they use that kind of a yardstick. And in this case, already, they have got some sufficient runs on the board. Investors have already scrutinized a lot of ideas. I know this angel investors firm and also no VC firm, and they say they get every year on an average anywhere between 4 to 5 thousand applications or people pitching to them. And do you know how much in how many startups they invest? Hardly 15 or 20. So which means if someone is getting invested in Series A, they have gone through a lot of filtration process. The investors have really filtered, evaluated the idea, and of course sometimes they would have missed a good opportunity. But again, they want to make sure that they are investing in spite of the fact they know it may not make profit for a while, but they want to know, will this startup, will it get valued at least 2.5, 3, or 10 times the investment. So they want to expand into other similar markets. They know what is their best selling product, so like the flagship program and things like that. And they also want to prepare to make sure that they can take it to the next round of funding, Series B, where the big players like the venture capitalists, also known as vulture capitalists, because they don't just come after the share in the company, they also come after the management. And this is where it might get valued for more than 25 to 100 crores. And it continues. So this is one of the main reasons why investors invest, even if a startup is not making profit, because they want to make sure that startup is valuable for the next investor who would like to invest. Now this graph, you can see the orange line is the sales. Initially, business is not making any sales, but the moment they have that first customer, that is like the proof that someone is there to exchange money for the service or the product that they're offering. So someone is seeing value and they're ready to give money. And if more people are giving money because they see value in the problem that startup is solving, then yes, you will have more people who will be buying it. And if at all it is repetitive, oh boy, it is going to be even more valuable. Now, someone recently told me about this toothbrush test. So what's a toothbrush test? How many times do we use on an average? At least 2 times, morning once, a night once. So do you have a product or a service that you're selling which people are going to use it at least once or twice a day? Which means, is it repetitive? Is it something that is going to always add value? If yes, then the chances of the valuation of the company, provided you have the monopoly and so on and so forth and many other factors, then yes, investors would love to invest. Then you have Series A, B, C, it goes on, or stage 1, 2, 3, and you have got different investors who jump in. You have initially the family, friends, partners, and then angel investors, VCs. Ultimately, they want to make sure that this company gets traded in the IPO, initial public offering, in the stock market, where any public can invest and buy share in the company. So the aim of every investor is to make sure when they invest in the next 1.5 to earlier the better. In fact, some of them invest as if they want that money as of yesterday. They get that investment by taking the valuation of the company to a next stage. So I see a question by Kushi who's saying, newbie investor can invest in loss-making company. Don't you think it's risky for them? Good question. Now the question that one should ask themselves, the newbie investor should be asking themselves is, Kushi, what is their risk appetite? And this is where I usually tell people, please don't take the gambler's approach. Now in James Bond movie, in the Casino Royale or whatever, you see James Bond saying all in. That's good in a movie, but please don't do it with your own money unless and until you know that you can take that risk. For many people, 50,000 rupees might be their risk appetite. For some of them, it might be 5 lakhs. For some of them, it might be 5 crores. For some of them, it might be 5 million or 50 million. So even if they lose 50 million, they might be like, okay, still the show goes on. It's fine. So one has to understand their risk appetite. And if someone is investing, especially in a startup, if you ask any expert, this is what my mentors in the investment world said. Chinmay, first make sure you have taken care of your back by having some money in your bank, having some investment in mutual funds, having some insurance that covers most of your health and things like that, some in probably stock market, some in real estate, some in gold. And then one of the portfolios that people are adding these days in their existing investment is a startup. So yes, startup is very risky. As I said, out of 10, they know 5, 6, 7 of them will miserably fail, but one has to take that risk. Again, no, higher the risk, higher the return, lower the risk, lower the return. I know we have just crossed 1 minute since we started, 30 minutes since we started. So let me quickly wrap it up by giving you this example. I'm sure you all know about Uber. Do you want to quickly take a guess? Type it in the chat box. How many different rounds of funding Uber went through? Just throw some number. How many different rounds of funding? Like series A, B, C, D. Anybody would like to answer this? How many different rounds? And along with that, I would also like to ask you, how much money do you think in total they raised? Probably I'll give you like 5 to 10 seconds, hoping that someone will type in some answer. Just throw out some number. Okay. Usually when I ask this question, some people say maybe 10 rounds of funding, maybe 15, 20. Uber went through 23 different rounds of funding, and all put together, they raised 24.7 billion dollars in funding over 23 different rounds. And of course, even they wanted to take the company to the IPO, to the stock market, and they wanted to value the company anywhere between 85 to 90 billion. They got valued at 82.4 billion. So imagine, see, simple math, 25 billion people have invested, valuation as 82, that is more than 3 times the investment. So most of the investors who invested in Uber definitely made a decent, if not a great return. And here are the last 6 or 8 different rounds of funding. In 2016, 200 million. And look at this, Saudi Arabia Public Investment Fund. They invested 3.5 billion. So this is like, no, they were preparing to take the company to an IPO in 2016, 17. However, the biggest competitor for for Uber is Lyft, LYFT, who are pretty strong in the Asian market. Even they wanted to take the company to the IPO. So again, they were all closely watching each other. And Lyft, I think they went to IPO in 2017 or 18, something like that. So Uber kind of said they will take a back step. But because they were burning so much of cash, they had to raise more funds. And look at the SoftBank, 1.3 billion. The same day on 28th December, $7.7 billion. Toyota invested $500 million because one of the biggest expense for Uber is paying their drivers. They are working on driverless cars. So imagine having a driverless car. Obviously, Toyota want to make sure all those cars will be from Toyota. And then even PayPal invested $500 million because they want to make sure all the transaction that happens online is through PayPal, and they get some share in the pie as well. So this is how the investment world works, where the investor has that mindset. Doesn't matter even if the company is burning cash, I will invest, because when we take that company to the next stage, we know to a great extent that it is going to be valued at least 3 to 4 times the money that they have invested. So I hope the answer to the question why investors invest in a loss-making company has been answered, and you have got a different perspective and clarity with regards to it. Great. We have got 10 more minutes. Would be more than happy to answer any question. If you have got any question, type it in the chat box. Maybe Chetna, you can help in coordinating it.
Thank you, Mr. Ananda. It was indeed a very interesting workshop. So now we will move to Q&A session. The first question which we have is, would buying a group of loss-making companies and branding them under a single name could somehow lead to making profit?
Sorry, could you repeat that, Chetna? I missed the first bit. It was
Yeah,
a
sure.
group of companies.
Would buying a group of loss-making companies and branding them under a single name could somehow lead to making profit?
Well, there are many factors that needs to be taken into consideration. Simply because some companies making a loss now doesn't mean that it may not generate profit or it may not be valuable. Again, depends one in which industry they are in, two who are the people who are driving it, and three what's the potential in that particular industry. Like for example, most of the airline industries, most of the airline companies, no, they are making loss. So when Kingfisher bought Air Deccan, it was a loss-making company, and many investors, they were like, "Oh yeah, Vijay Mallya, I'm going to invest. He's been a successful entrepreneur." Yes, he was a successful entrepreneur and he had proven himself in the liquor business. However, this industry was different altogether. So one has to be very careful with regards to, again, they have to do all those fundamental analysis regarding the industry, where it's heading and what's happening, and many other factors. As I mentioned about that particular venture capitalist who said, we are as good as our next investment. All it took was, unfortunately, Vijay Mallya to invest in that, and pretty much what all he had built in the last 30, 40 years, yeah, it's gone. So yeah, one has to be careful and they have to do their own research.
Yes.
Sorry, Chetna, I'm not able to hear you. I think now it's better.
Now it's better?
Yes, audible.
Okay. So another question we are having from our viewers is, when a profit-making company merges with a loss-making company, will there be any benefit to the portfolio of investors of both the companies?
See, sometimes it might be a strategy with regards to buying a competitor. It might simply because they want to create more monopoly. Like for example, Ola, when they launched, they had many other players who were offering very similar service which Ola was offering. One was called a Taxi for Sure. So two founders of the company, they were techies who ended up starting this. They got their first investment as 5 million, or sorry, 5 crores. So I had met one of the the founders. So I was listening to their story, and they said, you know what, we knew Ola was one of our competitors, and it's like, no, you're playing a cricket match against each other, and you really hate them, but all of a sudden in IPL you have to play next to them. You have to share the same dressing room. So even the same thing happens in the investment world when investors decided in Ola that, you know what, let's buy them out. And they bought Taxi for Sure. Of course, even Taxi for Sure was making loss for 200 crores. Main reason, again, the strategy behind was to make sure that they are capturing the market and they're kind of creating a monopoly. So with that perspective, yes, it was definitely a success. Now, that doesn't mean that we can apply the same strategy to, again, every business or industry.
Okay, so another question we are having is, what obstacles can an investor face while investing in a loss-making company?
Oh, definitely not. That investors always take the worst case scenario and they make sure, okay, what is the worst thing that might happen if things doesn't go according to plan? And they might say, you know what, if I don't recover the money, can we still continue with our investment? So with regards to the obstacle, mainly it's the founders, because especially in a early stage funding, investors are not really investing in a startup. They're investing in the startup founder because they are the ones who are going to drive the business. As Steve Jobs said, you cannot grow a company without growing the business owner. So if the mindset of the founder, if the mindset of the business owner is this kind of, they have a lot of limiting belief, then it becomes really challenging, and they will always be like an obstacle. And again, now in the investors world, there is something called as type 1, type A error, type 2 error. So what is type A error is when they have made an investment in a company after doing all the due diligence and still that startup or the company fails. Type 2 error is they've done all the due diligence and they decided not to invest. However, that company went on to get valued and to become a unicorn. Now, I know investors who had Swiggy in front of them and that pitched, but they said no to Swiggy because they said no, it's very highly valued. So they said no to it. So that's a type 2 error. Now, investors in their world, they say type 2 error is pardonable, whereas type A is not. Because if, in spite of all your due diligence, still, if your investment you're not able to get it back, then somewhere you're missing something.
Thank you so much. It just reminded me of the factor which I read that risk bearer can only have the profit. This is the main like risk bearers can have the profit. So
Exactly.
another question we are having is
Mhm.
from what is the average time period investors should keep in mind in order to achieve positive ROI from a loss-making company?
Again, see, when we talk about ROI, we are not talking, if it's a loss-making company, then definitely getting money in form of dividends after business makes all those profit, not the profit and loss where I explained. And from the net profit, getting the dividends, the chances are very less if the business is making a loss. However, when it goes to the next round of funding, now this is where they try to skim the milk. Let's say now you're boiling the milk, and then whatever comes to the surface you skim it, and then again you skim it. So let's say you've invested 1 crore, and in the next round it's valued at 10 crores, and in that round probably you sell 10-20% of your share. When it goes to the third round, then you skim part of your share. And again, many of the investors, they say, you know what, I only invest in seed stage funding or only in series A. We don't get into venture capitalists, and venture capitalists say will not get into any investment less than 50 crores, or sometimes then they say not anything less than 50 million we don't even touch, which it has to be more than. So every investor, they know their risk appetite, they know how much they want to invest, and they also know to a great extent which industry they want to invest. So accordingly they want to, they are like, if I make so much, then yes, I want to exit and reinvest in more startups.
Okay, so this question looks very interesting. With reference to the Paytm case study, does the number of users of the application of the loss-making company can help in its evaluation?
Definitely yes, because that is one of the question an investor would ask. How many people are using it? How many people have downloaded your app? How many users have you got? So this is where they get excited. Yeah, we got 100,000 users. We've got 1 million. That pretty much says that, okay, these many people are using it. And very soon the chances are they might get addicted. It might become part of their lifestyle using that app. Now, I'm pretty sure most of us, we are using WhatsApp to a great extent. We are using Facebook to a great extent. We're using LinkedIn, Instagram, Twitter, which was not there at all. So they said, hey, it's something free, take it. And then one of my mentors said, if at all you're in a place, or if you have bought, if you're in a marketplace where something is offered for free, then remember that you are the product. So that 1 million user, yes, we are the product, because eventually all it takes is for them to show some kind of an advertisement, a relevant advertisement, and then yes, that's what no Facebook and all those people are doing. So with Paytm, definitely they want to make sure that more and more people are using, and then they're creating a monopoly around it, and all it takes is offer them some kind of a service and charge few paisa, which would be crores of rupees per day for them.
Absolutely. So another question we are having from our viewers is a loss-making company eligible to give dividends after merging with the profit-making companies?
Again, it depends on the board of directors. Uh, if they are merging and if they are saying, you know what, let's say with Paytm, let's say there's another very similar company offering what Paytm is offering. Let's call it as PayTP, whatever. And if they have got 500,000 users, and if Paytm want to buy them out, then they usually will buy out the investors, and they'll make an offer where the investors in the second company, it's very hard for them to say no to that offer. Or in case if they still want to hold on to the share, then they might, but again they'll have to wait to get that dividend. And then most of the investors, they'll be more than happy to take that money right away, because 100 rupees today is far better than having 105 rupees 1 year from now.
Right. Yes, I guess we are taking one more
Chitra, I
question.
see a couple of questions in the chat box. Shall I take that? So we
Yeah,
have a
yeah.
LinkedIn user who has asked how to choose the right investor for various stages of your franchise. Well, I don't know who has asked this question. This for me sounds like how to find a right life partner. You have to figure out yourself. First, you have to understand which industry you're in, industries the investors invest in, because this is one of the common mistake many startup founders do. They're like, money is coming, okay, I'll just take from this investor, that investor. But do some research about that investor, because the last thing you want is someone who is micromanaging, and every single day, there's such a pain for you in the morning because they're asking hundreds of questions. Now, I'm not saying that investors should not ask questions, but some way they should have the belief in that investor once they have invested. Because I've seen so many times now where people have taken funding and they're like, oh my God, why is that I've taken so much of funding from this investor? Now, I'm pretty sure when we were children in school, when we were asking 5 rupees or 10 rupees or 50 rupees from our parents, how many questions that they were asking? What will you do? Where will you spend? Okay, after you buy the cricket ball, come and show. For that 50 rupees that we were asking so many questions, and if we are expecting 50 lakhs or 5 crores from an investor, I'm pretty sure that they want to make sure that they have invested or given that money to someone whom they can trust. So make sure that the fit is right and they know the industry very well, because last thing you want is just the money. Because even I have gone through quite a different rounds of funding myself, and I was very clear that with the software that I have got, I don't want any real estate investors who are like, no, you know what, I'll give you 1 crore, I'll give you 5 crores, and you give me so much of return every year, and then you can return the whole amount after 5 years. I said, sir, I don't want that. Rather, I want an investor who has experience in the software industry, who can open doors in different geographical location, who has got a very strong connect in, let's say, in a business association, and who can take it to their existing clients in some other startup that they might have invested in.
Okay.
There is one more question. Shall I take that, Chetna?
Yeah, sure. Shall I read for you?
Think it's fine. It's visible here, which says what traits and qualification to look out for other than their pocket size. I'm afraid I'm not able to understand this question. So, Chetna, would you be able to help me? What traits and qualification to look out for other than their pocket size? Oh, okay. I think this is what I'm under. This is how I'm understanding it. When you say pocket size, let's say your risk appetite, and let's say you've got 50 lakhs or 1 crore as your investment in your pocket. So, what are the other things that one should look for? You know, there are again, when it comes to filtering or evaluating an idea, there are many stages, I'm sure you might have heard of something called as an elevator pitch. The term
Yeah.
elevator pitch, it came because back in I think 1930s, in US, in Hollywood, the place where all the English movies were shot, they had this particular studio, and the floor up was where all the producers and actors used to hang around. So they were using an elevator. and all the storytellers, they were running with their script, and all they had was that few seconds to go from level, let's say ground floor to first floor in that elevator with that producer. So they had to pitch their story in that elevator, and that's how the term elevator pitch. So the traits and qualifications in a startup, one would like to initially understand, is this idea, does it tick the first three boxes, which is AMR? A stands for achievable. So whatever you're saying, is it achievable? People might say, you know what, I want to come up with a vaccination where you just take that one shot, you don't have to worry about COVID again. Great, amazing idea. Is it achievable? Two, is it measurable? People come up with all those fluffy, colorful ideas saying that, oh, these days, no, mental health is a big challenge with all this lockdown. People are getting into depression, and we want to come up with an app for this, and we have to do this. Yes, great, but how can I measure it? Can I measure it by number of users using the app? Can I measure it how much time they're spending on the app? Can I measure with regards to what exactly is the pain point and what's the solution we are going to? So M is measurable. Third thing is very critical. R, is it repeatable? Can I repeat? Can I give the same solution for different people? How many people in the world are experiencing the same problem? So if we look at all these unicorns or decacorns who are all over the world, they were able to tap into that problem. They were able to give that value which most of the people all around the world wanted. So yeah, these are some of the, this is like very early stage that an investor would be kind of not thinking in their mind. If those boxes are ticked, then they say, you know what, maybe send me your pitch deck, let's discuss in the next stage. And then they start like dating for a few times and then understanding what that idea is, and they do the due diligence, and yes, investment happens. I don't see any more question in the chat box, Chetna.
Yeah. So I guess it's just the clock tick its time so fastly that we even didn't know about the time. So yeah, thank you so much, Mr. Ananda, for connecting with us today. It was indeed a very insightful session.
Thank you, pleasure. It's always great to be presenting in with along with Dutch uncles.
Indeed. So thank you so much, everyone, for connecting with us today. So we will be coming with the next episode next week with a new speaker. Till then, stay tuned with us. Have a good day.